about bad debts. There's two aspects to bad debts. There are, in order to claim bad debts, you need to meet the criteria of Section 11I. Right. Section 11I basically has two core components that you have to meet in order for you to be able to claim the Section 11I bad debts allowance. Criteria 1 is that the amount must have been included in gross income. Now, that is, if you go and have a look at the request for information, if we go and look at this paragraph here, that is why they are asking for the invoices or the general ledger or the proof of income earned. Right. Effectively, what SARS is trying to ask you to show is what one of the first criteria for Section 11I is, did you include this amount in gross income? Put differently, can you show the flow from here's my debtors book, here's the invoice that generated it, here's where it showed in my taxable income. That's the causal chain that they're effectively trying to get to. If it wasn't a sale that created the debt, but it was, for example, an amount received in advance, or it related to some random once-off events, like maybe you sold some small trading stock, or some other miscellaneous thing, and you don't have an invoice for it, then basically anything that shows the causal link of here's what triggered the money, here's where it showed in my tax return, and the flow through from trigger to GL to tax return is what SARS is looking for. Because effectively what you're needing to prove was this amount was included in gross income. Right. This, I think, for most people should not be difficult, because I'm really hoping that you're only claiming the bad debts allowance on items which have been included in gross income, such as your trade debtors. If we go and look at the criteria, though, this could be broader. So, for example, if you charged interest on a loan, so you lend someone money, you charge them interest, and then you realize this person's not going to be able to pay me, I need to write the interest off it as bad, then of course you're not going to have an invoice for the interest, but you'd have a loan agreement, you'd have an amortization table, you would have your interest account, and then you can show the flow through to your income tax return. So that would still be or meet the first criteria, because I do have a bad debt, I do have a gross income inclusion, which then means I can go and test for the second criteria. Right. The second criteria is prove that the debt is bad. Right. This is honestly the biggest point of contention that generally pops up when it comes to bad debt write-offs, because as I say, the gross income component should be easy. In terms of the case law that we have with Section 11I, the case law certainly doesn't say that a debt can only be shown to be bad if you've instituted legal proceedings. Right. So from that point of view, no, you aren't required under law to have a debt recovery agent look at collecting this for you in order for you to be able to claim it's bad. I mean, heck, you could probably go and there's certain, think of like the whole African Bank debacle. If African Bank owed you money, you could probably just have gone, owed money, newspaper headline, hello, and you'd probably would have got the bad debt write-off. Or if you've got conversations with the directors, basically what SARS is looking for is they are looking for some indicator that you have attempted to recover it and the debt is genuinely irrecoverable. So the way I always think about this is, or the way I've experienced this in practice, is that there's very much a sniff test element to the paperwork you need to submit here. Because if the person whose debt you are writing off is a completely unconnected third party to you, you are never going to deal with them again. It's in your best interest to try and recover it as much as possible. Then SARS is generally going to accept some form of credit review. They're going to accept communications from you to the third party. They probably even accept if you can show the phone records of your receptionist or whoever does your follow-up, showing that you've tried and phoned and emailed X number of times to try and collect the debt and you're not getting any responses. Other items that would be helpful is minutes of board meetings or minutes of directors meetings where you can show that you have attempted to recover this debt, but it is not going to be possible, right? The reason why what we need to be careful of here is SARS is entitled to check or sense check what our reasons were for considering the debt bad. Because under law, a debt is bad when it is fully irrecoverable. In other words, I need to show that I've actually given up on recovering this claim, that I've effectively, for all practical intents and purposes, waived my right to recover this amount. That I've basically gone and said, I'm walking away from this. This money is never seeing the light of day again. Okay. So there's a comment that's come through from the chat box now to go and say, yes, but a medical aid could argue about the payment. They could quibble that you weren't covered or you need to go and recover directly from the patient, or they may send it to advisory board and you don't know what the outcome of that board is going to be. Say yes, until you actually get feedback from the medical aid that they are definitively not going to pay you, that debt is not bad. Think of it like putting in a claim with the insurance company. Is if I have a right to have the insurance company pay for me, but they're quibbling about the amount, I don't just go and say, you know what, I'm never getting anything from the insurance company until such time as I've actually exhausted my legal avenues. Right? It needs to be a similar idea or a similar thought process from a bad debts point of view. Because remember, that's also why we have 11I and 11J. 11J is exactly there for those, we don't think we're going to be able to recover this, but I haven't given up legal hope yet. Bad debts is for the point where you have to go and say, I wash my hands of this, this is never seeing the light of day. And that might be the better way to think about it, is doubtful debts is for where you're going, I don't think this is not, I'm getting that little bit of a twitch between my shoulder blades. This is not looking good. Bad debts is when you've actually given up. And I struggle to see how you could explain to SARS or anyone else from a commercial point of view for that matter, where if you have a valid claim with a medical aid, they just, not being very speedy and paying you out, that makes it a bad debt. You still have a legal claim for that amount. They just haven't paid you yet. Doesn't make it bad. So if I can paraphrase this, the reason SARS in their requests for additional information when it comes to bad debt write-offs asks for the legal documents. It's not because by definition I can only ever have a bad debt write-off if I've consulted a lawyer. Okay, that's not what the case law says. That is not how the law or the regulations or even the interpretation notes work. Why it is important, though, is if you don't have legal documents, you better have something pretty darn ironclad as to how you determined objectively that this amount was irrecoverable. Because please bear in mind also, an impairment for accounting purpose does not equal a bad debt. If I impair an asset, or if I impair a loan for accounting purposes, I still have the legal right to collect that amount. I'm just reflecting that my probability of my recoverability, essentially. The bad debt is probably the easiest way to think about it is to think of the accounting terminology from 30 years ago, where you always kept the data in the books to keep it alive and to keep prescription from ticking and starting. And your bad debt write-off was the point at where when you looked at it in your debtors register and went and said, you know what, this thing is gone, I am never getting it back, and it's actually not worth recovering anymore. That's the point at which you've actually given up properly trying to recover it. And that's when you claim the bad debt allowance. So part of the difficulty here is that there is never going to be a textbook one-size-fits-all statement as to what documents you need to have, just because debts do generate differently. What I want you to consider very carefully, though, is that if you're going the bad debt route, if you're going 11I, you are effectively saying, I've rescinded my legal right to collect that money. Now, in the context, and this is also something just to think about, in the context of the medical aid debacles, if you are effectively billing on the basis, if the medical aid pays, I'm charging 1,000 Rand for, charging 10,000 Rand for this procedure. If the medical aid doesn't pay, I'm expecting 2 grand cash from you. Then let's also be brutally honest here and call a spade, and you could possibly fix half your problem by getting your classification right. Because if you've invoiced 10,000, but you always knew that was the medical aid price, and if someone came to you with a cash price of 2, then that difference of 10 minus 2 is not actually a bad debt. It's not a Section 11I issue there. That should actually be treated as a discount. Because what you've done is you've actually adjusted the price. You were never expecting to get 10 grand from the client themselves or the individual themselves. You were only expecting to get the 10 grand or to bill that if the medical aid was paying. So that actually may be a better way of thinking about it. All right. How did you determine this debt was bad? What I also want to go and emphasize here, because this is another common misconception in this space. So, in order for me to claim the bad debt, I effectively have to have walked away from my legal right to reclaim that amount. Either because I don't think it's recoverable, or because, the company actually has gone bankrupt, or because I've tried to recover and I failed. I need to have effectively gone and said that I don't think this is recoverable. I'm giving up my right. Or I'm waiving my right, or I'm not going to bother enforcing my right. Probably not going to bother enforcing my right is a better way of phrasing it. For bad debt, that's for bad debts. So you can actually do it before the debt has that debt claim has actually legally properly prescribed. You could go and say, look, as soon as the person goes into liquidation, you look at this and go and say, yeah, I'm getting nothing out the liquidation process, and you write the whole thing off it as bad. However, from a CGT point of view, if there's a loan or an asset where someone owes you money, a lot of people think that the CGT rules work the same as the bad debt rules. They don't. Remember, for CGT purposes, my respect or my disposal in respect of that debt, the timing is housed in para 13 of the 8th schedule. And I can actually only go and claim that there is a disposal on the day in which my right is actually properly scrapped or waived. So I need to technically actually have gone and taken that step to where the debt has prescribed or where I have formally waived my right to claim the amount. And it's only then that I can claim the CGT, the capital loss. Now, this is particularly prevalent or obvious if we're dealing with a liquidation scenario. Because in a liquidation scenario, if it's a trade debtor, I can look at this and go, I don't think I'm getting nothing out of the liquidation process. Write the whole debt off as bad, claim Section 11I, move on. But if it was a capital asset, then I'm sitting in para 13 of the 8th schedule, and I can actually only claim the capital loss when the final L&D has been issued by the administrator of the insolvent estate. So it's only when that final liquidation distribution is actually signed that I can claim the capital loss. The technicalities matter in this case quite hugely. Please make sure you are actually applying the correct provision. Right. If you want to do a bit more reading on that, the Comprehensive Guide to CGT actually has some really good examples and goes through this discussion in quite a bit of detail under the para 13 section of the guide.